Welcome to the Real Estate of Things podcast. I'm Jeff Tennyson, the CEO of Lima One Capital, and I am guest hosting today for Dalton Elliott, who is out for a week, but has done a great job building this podcast and putting some great content and a lot of great partners of Real Estate of Things, sharing ideas, sharing thoughts. And so we're really pleased with what's been going on with the real estate of things. And today we have a great guest joining us as well, Gudmundur Kristjansson, who is the co-CIO for MFA Financial. Gudmundur, welcome to the real estate of things.
Jeff, thank you. Thanks for inviting me to join this podcast. It's fun to be with you here to talk about the BPL space, and I'm excited for a conversation.
It's going to be a lot of fun. Gudmundur is as I mentioned, the co-CIO for MFA Financial. MFA is a publicly traded residential mortgage REIT, and I guess I should add at the onset the recent new owner of Lima One Capital. We announced collectively July 1st that MFA has acquired all of the shares of Lima One Capital and become our owner. That's been exciting for us because MFA, you and MFA have been equity partners and whole loan buyers of Lima One for 4+ years. So the whole transition from partner and whole loan buyer to now owner has been really a fun transition and a fun process. So we'll get into that maybe a little later in our conversation, but wanted to make sure. So, tell us a little bit about MFA. What is a mortgage REIT? How do you and your team play with the business purpose lending space? And just tell the listeners a little bit about what's going on.
Thanks, Jeff. Appreciate the question. So MFA Financial, we are a mortgage REIT. We're headquartered in New York City and listed on the New York Stock Exchange. We have been publicly traded for over 20 years with over $2.5 billion in total equity base. We invest kind of across the residential mortgage space, which includes both securities as well as whole loans, but with primarily focusing on what we call credit-related assets. And that really means securities, whole loans that derive most of their yield income, if you will, from credit as opposed to just interest rates. Historically, we invested in securities, and this is going back in time to the early 2000s to 2010, where we invested primarily in securities. These were Fannie Mae, Freddie Mac mortgage-backed securities, some private label securities backed by mortgage whole loans, non-performing and reperforming loans, as well as notes backed by mortgage servicing rights. And really after the 07-08 financial crisis, we got really aggressive and deep into credit analysis, and that's when we acquired a lot of what we call legacy non-HCMBS. These were securities that fell in value after the subprime crisis. It was a great trade for us. It went well for us for many years. But more recently, we've been primarily focused on investment activity in what's called non-QM and business purpose whole loans. And that's where most of our activity is these days, and where we're finding the best opportunities kind of in the residential mortgage space. We have an investment portfolio of over $7.5 billion. Wow. Of that, approximately $1.3 to $1.5 billion is kind of business purpose loans.
So talk a little bit, let's talk about kind of the whole buying process that you guys go through. We've got a lot of listeners who are private money lenders on their own accord, small private money lenders that would be interested to know. Talk about when you're buying, you guys, you mentioned, you bought a big chunk of business purpose loans in Q3. So you're very invested, not only in Lima One, but in other lenders as you guys buy business purpose loans from others. Talk about what you're looking for in an originator that would catch your attention and interest you in buying their loans.
Right, that's a good question, and as you mentioned, and you kind of alluded to it on the beginning of the podcast here, we have known each other since 2017 when we first got to know Lima as we got interested in the broader BPL space, and so we put a lot of effort into kind of researching space in 2017, kind of identifying it as an attractive area to deploy capital. So we met with various originators, figured out what products made sense to us, and started acquiring loans. And we've bought over 3.5 billion of business purpose loans since inception. And really, what we're looking for now that we've got a lot of experience under our belt is, we look for partners that think about credit similar to us. It's important to kind of see eye to eye fundamentally on where do you want to deploy capital, because when you build a whole loan trading relationship, there's a lot of energy and effort that goes into negotiating, loan purchase agreement, various legal documents, setting up the trading process, the settlement process. And so, before you go down that path and invest energy and time into it, you want to make sure you align fundamentally in terms of the approach. So it's important to us that the originators almost think as principals in the terms that they, want to create, quote, good product, that they care about their borrowers, that they perform on their mortgage, but also that the borrowers are successful, identify good projects, exit profitably, and so on and so forth. And we find when we take the time to build those relationships and identify the right partners, that just bears incredible amount of fruit down the road, because it means that, if when things get rough, we're all aligned, as opposed to fighting among ourselves when there are issues, because stuff always happens.
Yeah. Is there a size limit because there's a lot of work on both sides. There's work on your side in approving an originator to buy their loans. And I'm assuming you're expecting on the other side, originators to also have some procedures. So what's the typical size of a bulk of loans? I'm assuming you don't buy one loan at a time and that type of thing. You're looking at larger bulk purchases.
That's right. We like to set up, as you say, bulk purchases, but most likely it's what's called a flow arrangement, where we're routinely buying a pool or a bulk of loans, every single month, multiple times a month, and so on and so forth. And look, since we are a large publicly traded company, we have, as I mentioned earlier, 2.5 billion in total equity and over 7.5 billion in assets. We are looking for something that is meaningful to us, that can make a difference for our shareholders. And so as you think about that and put it into context, we ideally would like to see someone who is, has the ability to sell us, 25 to 50 million a month of paper, right? But the other way we think about it too is, if you identify someone of quality, that has maybe an undersized, operation, but who clearly has the ability to grow, we can be, somewhat patient and help them in other ways to grow. One is to provide the certainty of the takeout from the loan perspective, but also in some cases, make equity investments or other capital commitments to nurture those companies and grow over time. Similar to we did with Lima back in 17 and 18 and later. So
well, and I think people listening to this should recognize that's exactly from Lima One's perspective. We were doing 15, 20 million a month in total production when we first met.
Yep.
And you guys, helped us by buying, 3 million, 5 million, 10 million, those kind of things. But you had a vision, as did we, to get to where that 25, 50 million a month was something that was worth your time and worth our time. So it's because I'm assuming typically when you're buying these loans, you're not actually table funding. You're buying closed loans that these originators have already underwritten, closed, and have them on their warehouse lines today.
That's correct. We buy closed loans. MFA is, we're not an originator. We're not licensed as such, which requires, other legal operational aspects, which you as an originator quite well know. And so we are an asset aggregator, and as such, we work with multiple originators to source our loans and purchase from multiple entities. And so which can be challenging. You gotta manage multiple relationships. You gotta build them, you got to nurture them, and you got to identify the right partners. And it's also, a competitive space out there. So, from our perspective, again, like I said, like it is very important to identify the right partners, and then, work on those relationships, not unlike, any other successful relationships, to get bigger over time. And like we also like to, support our partners, as I said, to help them grow, because selfishly, if they are producing good quality loans that are attractive and high yielding, it's in our best interest to allow them to do more origination, so we can acquire more loans.
Well, I think a lot of times, so many private lenders or small entrepreneurial led originators, and they're like, how can we get large and big like, the larger national lenders? It really starts with teaming up with somebody like yourself, because there's the need for capital is horrendous at the point as you begin, because whether you're doing, putting it on your warehouse line and holding it till you can aggregate enough to send you 25 to 50 million, or, topic I want you to spend a little bit of time on today is securitizations. It's impossible to do a large securitization without a pretty big slug of capital. So I think
That's right.
I think the message to some of these smaller private money lenders is find a good institutional partner that will allow you to grow, that will support your ideas and strengths. And fortunately for Lima One, we found MFA and grew together, and it made a big difference as we did grow together and build together. We learned your strengths and you learned our weaknesses at times, and we kind of pulled those together to make those all work.
But to your point, I mean, like from the perspective of growing, like in terms of desire to get bigger. I mean, it is sometimes a double-edged sword, because you can be quite profitable and successful managing a small operation where you're controlling all aspects of the loan creation process. You can identify higher coupons maybe, or higher fees that you can charge on a smaller subset of loans in your local area, right? And that could be a nice niche. But if you want to scale up and gain volume, you really have to make it a repeatable process. You have to make it a repeatable process, not just to yourself and the next 2 or 3 people that you trust, but your whole organization. And then you have to start trusting people in the process. And to do that, to scale up successfully, you need to then start focusing more on the infrastructure and the operation, as opposed to optimizing the revenue on each individual loan. And that's where the strength of really specialization comes in, like allowing, for example, Lima in this case to focus exclusively on creating good loans, expanding their products, the product offerings, and then utilizing MFA's cheaper cost of capital and experience, as you mentioned, in financing and the securitization market. I think when you do that and you team up like that, you kind of build a whole manufacturing process where you're really creating value along the entire chain.
Yeah, that makes a lot of sense. Well, let's you bring up securitization. I think let's move to that, because we get a lot of questions from just industry partners and others about the securitization market. You guys are very active. MFA is very active in that space. What is securitization, and particularly how does it work to be a good source of financing for a mortgage REIT and with business purpose loans?
Right. No, that's a good question. I mean, look, the securitizing is nothing really. It's nothing new. I mean, securitizations have been around for a long time, and those that want to study it can read up on the birth of the CMO market in the 80s and the 90s, and all kinds of various structures, obviously made famous in the subprime crisis by various movies and books. But at the end of the day, like the basic concept is you're pooling a a group of assets that are similar to each other. In this case, whole loans into enough size, and then you take those loans and you pledge them, or they provide collateral to securities or bonds or notes that you issue and sell to investors in the secondary marketplace. And by doing that, you essentially create liquidity for either an originator that does it themselves, or an asset aggregator like ourselves, And at the same time, you give investors that don't have access to these types of particular assets an ability to invest in that type of credit or whatever the risk exposure is, and therefore creating liquidity for everyone across the whole food chain. And so, from that perspective, it really is a elegant mechanism. And in most cases, someone who's securitizing or a securitizer, they usually retain a certain amount of bonds. So they always retain risk in it or skin in the game. And in fact, right now it's essentially regulations or law that you have to retain at a minimum of 5% risk retention in the securitization that you issue. So essentially, by doing that, you're aligning interest that the people issuing these bonds have continued involvement with them. And if the underlying assets go bad, they suffer along with all the other investors. Now, as you pointed out, because of that, obviously, you have to have capital and balance sheet to retain that interest. And typically, MFA retains anywhere from 5 to 10% of the bonds of the securitizations that we do. And so, from that perspective, you need to have capital, and so a large balance sheet helps with that in terms of retaining those interests.
So, just to be clear, kind of the mechanism. So, when you talk about a retained interest, a 5% retained interest, a typical securitization would be 200 million, 300 million in size.
Yeah, so securitization I think like 200 million is usually, that's the size that you want to do, and we can get into it a little bit later. I mean, there's costs associated with that, so you kind of want to gain some efficiencies there. I mean, securitization they can be as large as $1 billion, right? But typically what we see in our market is probably anywhere from 200 to 400 or 500 million in terms of deal size.
And then, and so, I mean, I think that's important for people to truly understand. When you say retain, there's two elements to that. One, a 5% retention on a $200 million deal means you have to basically put into this deal $10 million.
That's right.
And not only that, but by being the bottom part of the capital structure in this example, or the bond structure, the first losses are going to come into that $10 million that you have to reserve for.
That's right.
Anywhere from a year to 5 years to 10 years to however long the bond is.
Yeah, that's right. So you're highly incentivized, obviously, for the underlying loans to perform because you take the first losses, and so you're incentivized to make sure the servicing is up to par. And it's we spend a lot of time when we market these deals to make sure people understand that our interests are aligned, and predominantly through this because our capital is at risk if something goes wrong.
Yeah. Now, I think that's important for people to note. I mean, you can't just do a $5 million securitization, primarily because of the legal cost and the regulatory cost and all the different components that go with that. And again, that's the value of a large partner, institutional partner like an MFA to folks like that's the reason you buy the loans, hold them, and deal with that oftentimes, as opposed to Lima One being the issuer of a securitization.
Yep, that's right.
And then in the BPL space, what's the big advantage of the business purpose loans today in that securitization market? Are you seeing it across the board in all the products that we offer? Where are you seeing the strength of securitization at this point?
Yeah, I mean, so the securitization market has been quite vibrant and lively over the last 18 months. A lot of volumes in just the broader mortgage space, and obviously in the conforming space, there's been a lot of loans created with all the refinancing. But in the BPL space, it's essentially two markets, broadly speaking. One is the term rental loans, and then you have the fix and flip, bridge, and the ground up aspect of it. And so on the term rental loan side, that market is more established, more matured, more accepted. Most of those deals are rated. So there's a rating agency that will rate the bonds in those deals, and the ratings go from AAA all the way down to BB. So it's AAA, single A, double A, single A, triple B, double B, and single B, and so on and so forth. And that those letters represent the credit quality on a particular security that's issued. But because they're rated, there is a certain amount of standardization, and it's well understood by various fixed income investors who also buy securitizations or bonds backed by other types of loans, loans that homeowners own, and so on and so forth. On the fix and flip side, the rating agencies, they don't have the same amount of experience, track record, data to analyze losses, because that's predominantly what they're looking at when they're putting the ratings on is what can go wrong. And so their
Right.
models don't fully capture all of those aspects of a bridge loan, of a fix and flip loan. So they just struggle with rating those types of deals in any meaningful way. And so those deals tend to be non-rated, and therefore there is more diversity in terms of the type of structures that are put together, and it's just less homogeneous. Now, there's been a decent amount of those issues though over the last, like I said, 18 months, and there seems to be developing a little bit of more standardization. There's still more room to go there, but the fact that there is a vibrant market is obviously a benefit for everyone associated with the BPL space, whether it's the operators on the ground, the people who are actually doing the work and rehabbing the homes, an originator like Lima or an investor like us, because it does bring liquidity to the space.
Yeah, no, it's an exciting. I mean, it's really great to see the rating agencies getting comfortable with it. That also adds another level of confirmation to the bond markets that the right processes and controls and all the different components that go with it, and it's the real benefit of kind of seeing us being able as an originator, that kind of method of kind of cost of funding, cost of financing as an originator is allowing us to have better rates, better products in the marketplace for our borrowers, and it just kind of snowballs down to all the people that get the advantage of an active, safe, important investment that the ultimate bond investors like.
That's right, and it's interesting you use processes, because many of these things are I guess somewhat mundane and boring, in the sense that, like, to be able to bring a securitization, you know having good data, having clean data, being able to tell the story that you service the loans in a certain way, how do you deal with delinquencies, how do you assist borrowers, how do you manage cash flows and funds, all these things that come along with, again, this is scale and operational aspect. But if you can get that done well, it helps you in terms of bringing better deals, getting lower cost of funds. But this is the thing that we talked about, scale, right? Doing a few loans and making very nice money on a few loans versus scaling it up. If you want to scale up, you got to do all these things right. Like, you got to do the servicing aspect well, and all the data and the operational aspect. But that then brings benefits, because you can bring securitizations and other things of that nature.
Yeah. Now, the hot topic in the business purpose space right now is mergers and acquisitions. Obviously, there's been a surge of acquisitions, like by institutions like MFA. You guys acquiring Lima One. I mean, Pretium just announced they acquired Anchor Loans. NRZ announced they acquired Genesis. PacWest acquired Civic. And then, a year or so ago, Redwood acquired Corvette. So there's the top probably 5 to 7 originators in the space have all gone through some kind of merger. What's creating the interest in the business purpose lending space to acquire these versus just buy the loans?
Well, I think it's a part of a broader trend that we've seen, not just this year and last year, but the last 5 to 6 years, really. Like, when you look at asset managers, private equity funds, people like us, mortgage REITs, just anyone who manages a large pool of capital in the the mortgage space, or even just the broader fixed income markets, with rates coming down, the Fed buying a lot of assets, it does create a competition for assets and access to assets. And so as some of the lower yielding spaces are crowded out, it pushes people to look into other areas and other spaces. And historically, the BPL space was fragmented. It was a lot of hard money lending, local lending, And so it was hard for institutional investors to gain foothold in it, because we talked about this a little earlier. To really accumulate size, you had to build a lot of smaller relationships and buy a lot of loans from many participants. So if you are an investor like myself, who's used to buying bonds in size, and really just you have a lean team, and you're good at doing the analysis, but you don't really want to manage hundreds and hundreds of like correspondent relationships. So from that perspective, as you look into the space and say, okay, it's attractive, I can make good returns here, anyone who has a good track record and is sizable and has the ability to originate loans across the entire country becomes then an interesting target of some of these larger players. And so I think that's really what we're seeing. We're seeing the importance of creating the asset, of controlling the asset creation, the flow of asset onto your balance sheet, and so and it's also just competitive. If I don't do it, someone else will do it. So you protect your turf. But I think it's a real vote of confidence in the space that people see real benefit, nice returns, and it's a commitment to the space too. Because at least from our perspective, I think it's really we're showing a tremendous amount of commitment. We're going to be here for the long run. This is not a short-term trade where we're buying a few loans. We envision this as a business where we can continue to grow it and do more in the future.
I think that's an interesting comment because, I mean, when I first got into the space, when Blackstone asked me to help them start B2R Finance back in, 2013, I guess it was, there was basically three players in this space. There was B2R, there was Colony, which is now Corvest, and then there was First Key, which doesn't exist anymore. And from that, at that point, the whole debate, we just finished the IMN single family rental conference in Scottsdale. And it's amazing to me that, less than 10 years ago, there were only three people on the stage that had any ability to originate. And as a result, the question was, is this just a trade or is it a true business and industry? And it should be real confirming for not only the originators listening to this podcast, but the real estate investors who we all serve through this process, because there is a very consistent national source of financing for their projects that with people like you and others in the space, there should be real continuity and real consistency, which does allow this to be a multi-billion dollar industry for years to come.
I think that's right. And I do think, the space is still maturing. And there's still plenty of way to go in terms of, bring more maturation, more, I think there's going to be more consolidation. Some of the bigger national players will get even bigger. There will be mergers that will happen. And I think that's all good. It's good in the sense that it brings, as the market matures, it brings tremendous benefits to, I think, the operators on the ground that are doing all the work, that are transforming the old housing stock in the United States, which is pretty old, and creating attractive, first-time properties or home ownership opportunities for families, which would otherwise not be there.
Well, I just read an article today, actually, by Redfin, and for the largest percentage ever of home sales were sold to investors in the third quarter. 18% of all home sales in the third quarter went to real estate investors. And it's not just the big, invitation homes, large institutional people. It's really, you still in this market today, the small 3 to 5 to 10 person who owns these properties is the dominant. 92%, 94% of these people are those type folks. And so it really does create real optimism as this industry matures, as our processes enhance, as all the different components that go with it make a big difference. Well, we're getting close to wrapping up. A couple of, it's getting close to Christmas. It's around the corner. So, I guess to do a little lightning round with you, Gudmundur, for some fun, tell us something interesting about yourself that listeners probably wouldn't just know. Your the name gives it away that you're probably not from South Carolina. But tell us a little bit about yourself, and maybe what's the big ask of your kids for Christmas this year?
Wow, that's a big one. So yeah, I think yes, but the name probably gives it away. Something foreign. So I'm born and raised in Iceland, and moved here in 2004 to go to college up in Cornell, Ithaca. Lived in Chicago for a little bit, and then I'm now in New York. And people get to know me, they say like, oh, okay, you just like to be where it's cold. And I guess that's not really true, but that's just how it turned out to be. We so now me and my wife now live here. Yes, we got two boys, 10 and 12, and we like living in New York City. And one of the nice benefits of that is it's a melting pot and all kinds of cultures, so that's fun. As it relates to my boys, what was the question? What do I want them from them, or what they want from me?
Yeah, what do they want from you? We really don't care what you want.
Well, I can tell you, there's a 10 and 12-year-old boy. So really, most of the things that they like has something to do with video games and computers. There's gaming, this and that, and or some sort of credits for some sort of a metaverse thing that no one understands. It's fascinating. They're great kids, but it definitely has something to do with technology and video games.
I talked to a friend here in the Carolinas whose 12-year-old son, like a year and a half ago, talked him into letting him spend like $500 for cryptocurrency. That today is like worth, like, I don't know, whatever he spent, it's worth like $200,000. And this kid's like, so I think I think our kids are going to teach us not only how to do video games and technology, but how to handle cryptocurrency.
I like that. I may steal that idea. I might tell them there are no presents; they are all in the form of some sort of a cryptocurrency.
Everybody gets one Bitcoin, and
that's right.
Then they'll have to keep up with the logarithm to keep up with it forever. Gudmundur, this has been fun. Thank you for taking the time, sharing ideas, sharing insights about the market and what's going on from the institutional side. Certainly wishing you and your family a great holiday season as that comes upon us. You're welcome back anytime. Actually, you'd probably have a better conversation with Dalton. So, next time we call you and ask you to join the real estate of things, request the real host, Dalton Elliott, and probably be even a more fun event. But thanks a lot. Appreciate it. And let's keep lending money.
Well, thank you, Jeff. I think you're being too humble. You did a pretty good job here. It was a great conversation. Thanks for inviting me, and appreciate the opportunity to talk about the markets and our relationship. And wish everyone happy holidays, and appreciate it.
All righty, thanks a lot. Talk to you soon.